Hi everybody, welcome back to the BizTech Academy and another video in our investment learning series. At the BizTech Academy, our primary objective is to provide education and information to support investors at all levels to make sound investment decisions. And when I say sound investment decisions, I mean decisions to both buy into assets and also to walk away when that is deemed prudent. In truth, if I was asked outright, I'd say I gain more satisfaction from those commenting that they've gained some knowledge or some insight from what I say to avoid bad investments than necessarily making good ones. And that's simply because my personal experience tells me that the pain and the length of suffering that you get from making a wrong investment is far worse than the high you receive from making a good investment. But that's not to say that I don't enjoy making money. And it's to this end that I'm producing these educational videos as well as my normal company reviews. And in this particular video, I'm going to look at the definition and the use of shares and warrants when it comes down to raising funds for a company, and also as an investor, what to look out for when you see these particular announcements. Before I go further, however, I must say, as always, that none of this is financial advice. I'm not a financial advisor, and everything I say today is purely my opinion. And of course, if you do like this video and you want me to continue doing tutorials or educational based videos, please give it a thumbs up and subscribe. Just press the little watermark at the bottom right hand of the screen. Any support you can give us is greatly appreciated. And before I go into the details, it's worth pointing out one other thing, and that is that this is a pretty basic or beginner video. This is about shares and warrants and when they're announced in an RNS, and when that happens, as an investor, what to look at and what to consider when making an investment decision. And to that end, if you are a seasoned investor, if you've been in the game for a long time, then you probably know this video. That's not to say you shouldn't watch it, but it is more aimed at those that are either beginners or intermediates, or those just afraid to ask. Just bear that in mind when you go through the video. Okay, so let's start with a fictitious company, XYZ or Z if you're in the US, PLC. And XYZ is a company that makes men's shoes. It's a listed company with 10 million shares in issue, and its share price today is $1 per share. And so the market cap of XYZ PLC is $10 million. XYZ PLC wants to expand and start making women's shoes as well. But to do this, it needs more money to spend on expanding its design team, as well as to expand some of its manufacturing capacity. For this, it estimates an additional funding requirement of some $1.8 million. Now, when a company needs additional funding, there are a number of avenues it can explore. It could go down the traditional debt route. It could get loans or bonds, for example. It could sell redundant assets and try and raise cash that way. Or it could even go into partnership with someone who can raise funds through that particular partner. However, for small cap companies, it's relatively common to issue new shares and warrants. With a share offering, XYZ will issue new shares on and above its current circulating shares. That's the 10 million shares at $1 per share valued at the current market rate. And when raising funds through share issues, this can be done primarily in 4 different ways. Firstly, there is an initial public offering or an IPO where a company floats for the first time. Our fictitious company XYZ PLC has already floated, so this is not relevant in this particular scenario. Secondly, there is a public offering where the shares are listed on the open market and anyone who wishes to can purchase these shares. Thirdly, there is a rights issue where the new shares are only offered to the existing shareholders. And finally, there is a private offering, which is even more exclusive, where the new shares are only offered to a select number of VIPs, if you like. The fors and against of each of these methods of issuing new shares is outside of the scope of this particular video. But if you want to know more about that, let me know in the comments and maybe I can do a video on that. But for the purposes of XYZ PLC, we're going to assume it's a private share offering that's being offered only to large shareholders and some relevant institutions. So XYZ currently has 10 million shares in circulation at a market price of $1 per share, resulting in a market cap of $10 million. It now needs to raise a further $1.8 million, and so now needs to decide on the share price of the new shares it will offer. The challenge that XYZ has is that it cannot offer these new shares at the current market price of $1 or above because no one would take up the offering. They would just continue to buy shares on the market if they were in the market for XYZ shares. And to this end, what XYZ needs to do is provide some form of incentive so that these larger shareholders and these institutions are tempted to buy into this new share offering. To this end, XYZ has decided to offer these shares at a 10% discount to the current market price, so at 90 cents each. To raise 1.8 million shares, therefore, this means XYZ will need to issue 2 million new shares. However, XYZ's board do not feel that this 10% discount is incentive enough, and the share offering may not be taken up in full if it's only left to that single discount. So the board has decided to add to the purchase of each individual new share a warrant coupon, allowing the holder to purchase one more new share in XYZ at $1.20 anytime within 3 years of the issue date. Of course, whether the warrant holder decides to do this will 100% depend on the share price of XYZ as we go through that 36-month period. If XYZ shares go above $1.20 sometime within the next 3 years, then it's highly likely that the individual warrant holder will buy those shares at $1.20 and then sell them very quickly at whatever the current market price is above that $1.20 and make a quick profit. If the share price does not go above $1.20 in the next 3 years, however, all that will happen is that the warrant will not be exercised, and at the end of the 3-year period, it will just lapse and become null and void. Okay, so that covers the institutional investor or the larger shareholder that's bought into this share offering. But how does this share offering impact you as an individual shareholder in XYZ PLC? Well, for you, 3 things can happen. And the first one is an immediate negative reaction. The second one is a possible negative reaction over the next 3 years. And the third one is a potential positive reaction that outweighs both of the 2 previous negative reactions. And I'll go through these now. The first and the immediate negative reaction that will happen is that your shareholding will be diluted. By way of example, and for ease of math, let's say that you hold 100,000 shares in XYZ PLC and you bought these whilst the company had 10 million shares in circulation. This would mean that you own 1% of the company. Assuming you don't increase your holding in XYZ, then when the 2 million new shares are issued, the total number of shares in circulation will be 12 million and not 10 million, and your 1% shareholding will be reduced or be diluted to 0.83%. That being the 100,000 shares you own divided by the new circulating number of shares, that being 12 million. Okay, so your shareholding has been diluted, but you don't really care because you still own 100,000 shares in XYZ. The market share price is $1, and therefore the value of your shareholding has not been changed. Well, unfortunately, that's unlikely to be the case. What generally happens when new shares are issued, and in the absence of any positive news that counteracts that issuance of new shares, is that the share price itself will go down by a similar percentage to that of the dilution percentage. In this scenario, the number of circulating shares in XYZ has gone up by 20%, and there's likely to be a corresponding drop in the share price by a similar percentage, which, of course, as a shareholder, is not great. And then we still have the warrants, and this is the possible second negative reaction that you may experience as a shareholder over the next 3 years. Assuming that XYZ share price does go over $1.20 at some point in the next 3 years, it is highly likely that some of those warrant holders will exercise those warrants and buy shares at $1.20. To do this, XYZ PLC will need to issue new shares to the amount that is trying to be bought through the warrant coupons being exercised. And to this extent, there will be a further dilution of your own shareholding. However, and this is when the potential positive comes in that outweighs the 2 negatives I've just discussed. Warrant holders will only exercise these warrants if the share price goes above $1.20. And if the share price has gone above $1.20, it's because XY PLC as a company has grown in value, and therefore so has your shareholding. And in truth, it's important to remember that this is the whole purpose of the share raise. The purpose of the funding is to provide XYZ with money so that it can expand into the women's shoe market. And by doing that, it should grow the business, generate more revenue, and increase shareholder value. And if this does happen, if XYZ does penetrate the women's shoe market, it increases the share price over the next 1, 2, 3 years or whatever, maybe up to $1.50, up to $2, then your 100,000 shares in XY PLC is worth more money. And this has to be more important than any sort of small dilution you might have experienced at the time of that particular share raise. And this is the crux of what's important when considering investment decisions in companies that you currently own shares in or you're thinking about investing in that have just made or are about to make announcements regarding share issues and warrant issues. If you're a long-term investor and you believe that the funds that are being raised from the particular share offering are going to be used wisely and ultimately these will translate into an increased share price in the company, then any short-term blip in that price following the announcement of the share offering itself is irrelevant because this dip will be surpassed and beaten very quickly as you go through the coming months and ultimately the coming years. However, if you're a short-term trader dipping in and out of the market and trying to make a quick buck and you require liquidity, then this share issue could be a problem. You want to try and avoid companies that are likely to do share issues, because if you're caught on the wrong side and the share price drops by 20% and you lose a lot of the money that you need to trade, you'll just have to sit and wait until that share price increases. Okay, I hope that made sense and you found it useful and valuable. And if you want me to continue doing these educational videos, or you have some subjects you want covered, just add them to the comments below. But in the meantime, please give it a thumbs up and subscribe to the channel. And again, thanks for watching, and I'll see you in the next one. Bye-bye.